Your phone buzzes with a notification. It's payday, and your direct deposit has officially cleared. We often imagine this money sitting inside a steel vault with thick walls, where neat stacks of paper bills wait for us to come pick them up. The reality is, 98% of money exists only as electronic records. That tiny 2% slice is physical paper and metal. When you deposit money, the bank doesn't put your cash into a small metal box with your name. Your account balance is actually a digital record of what the bank owes you. It is a promise to pay you back whenever you ask for it. Because we can't hold these digital records in our hands, our usual idea of having money is actually a reliance on these digital promises. To see how this works, imagine you receive a paycheck for $1,000 that goes straight into your checking account. Your bank app now shows a score of $1,000. This represents the bank's active promise to provide that value to you on demand. While your balance sits there, Jane walks into the same bank. She needs a $900 loan to buy a laptop. The bank sets aside a tiny fraction of your deposit as a reserve, then immediately lends the other $900 to Jane. Now, your single deposit is being used to support two different people's spending at the exact same time. Look at the totals now. Your app still says you have $1,000, and Jane's app says she has $900. Together, there is now $1,900 of buying power in the world. This isn't a computer glitch or a mistake. The system is performing exactly as intended. This is called fractional reserve banking. Because the bank can use one deposit to create multiple digital claims, they have effectively created new money out of thin air. The cycle continues when Jane spends her money. Her $900 enters a new bank, which then lends out $810 to someone else, multiplying the money again. Banks create the digital money in our economy by generating these new records of value every time they issue a loan. Since the bank has promised the same money to multiple people, what happens if everyone tries to withdraw their cash on the same day? This triggers a bank run. The system collapses because banks never keep enough physical cash on hand to pay every digital promise at once. To prevent this, the system relies on government-backed insurance programs that protect your savings. This insurance guarantees that even if a bank fails, your digital balance is protected by the government. This guarantee stops people from panicking and rushing to the vault. The entire banking system is held together by this shared confidence rather than a stash of physical assets. You can see this system in action every time you tap your phone to pay for a coffee. In that moment, two bank databases communicate and update their records instantly. These digital updates have replaced the slow process of minting metal and physically moving coins to represent value. Economic activity now happens within a digital network that updates millions of records every second to track who owes what.